In this video, I'm going to share 3 shocking realities, truths that we discovered after stumbling into early retirement. Hi, I'm Camille Gaines. Here and on my website, retirecertain.com, I write about and talk about our stumble into early retirement and how we eventually found financial independence after that stumble. But it wasn't without a tumultuous start. If you like this type of information, make sure you subscribe to my channel. That's what it's all about. And if you like this type of information or like the information in this video, I'd love it if you click that little thumbs up below the video. It means so much to me. So the first point that I want to make, or the first shocking reality I'm going to demonstrate with some information that you can see here on my screen. This is a little different than my usual format. And I've blown it up. I hope that you can see it. So this is 2000 through 2009, and about the time we did our stumble into early retirement was right around here in 2000. So what I want to do is show you the returns over the next decade for the stock market and also for a stock and bond portfolio. And I want to tell you about this resource so you can use it and go check out the information there yourself, play with the data. I always like to say we have to look at history to sort of plan and know how to plan for our financial future, even though we know that we're not going to have an exact repeat of what's happened in the past. We can look to the past to get reasonable estimates for what will probably happen in the future, both on the upside and on the downside. And when we couple that with what's happening in the economic environment, in the financial markets at any given time, we can really get some valuable insights that can help us achieve financial independence and help us become better investors so that we can both get better returns as well as protect our money, keep it safe. So let's take a look at this information. Now, this is from wealthmeta.com. I'll put a link in the description. And this is information by decade. Here we're looking at 2000 through 2009. And we can see that the compound annual growth rate for that entire decade was negative 0.92% if we included dividends in that return. If we excluded dividends in that return, like most investors would probably do that are retired, because they would be taking those dividends so they could have income from it, then we had about a 2.92%, almost 3% negative compound annual growth rate for that decade from 2000 through 2009. Now, this is just for the stock market based on the S&P 500 return. So all stocks then lost almost 1% on average for that entire decade. So this was a shocker for us, having stumbled into early retirement in in 2000, just before 2000. And there's a lot of details around the time frame that I won't go into in this short video, but here we were, early 2000s decade. So negative 1%. So that was a shocker. And the shocker was that what we realized after going through this decade of this compound annual growth rate, negative compound annual growth rate from stocks, was that things beyond our control determine the longevity of our retirement savings. We can feel like if we have a good asset allocation, meaning we put the right amount in stocks versus the right amount in bonds, or we choose the right funds, or we get the right ETFs, or we hire the right financial advisors, we can feel like we have control of our outcome as far as how long our money will last. The reality is we don't if we're invested in pretty much anything really that has a good upside return. And that is because the returns are based on economic factors that we just don't control. Things like the growth of the economy and interest rates, more specifically. Of course, there's also inflation. There are other economic related factors. There are macro global factors that affect how our investments will perform. So we didn't have an awareness about this going into retirement, and we felt like it was a shocker. We weren't prepared for this reality. We always felt like if we had the right asset allocation, if we had safe invested wisely, that this would end up, our investments would perform well. So this was the first thing. Now, I want to bring this back to kind of where we are today and how this relates to you today and me today, because this was, a long time ago. But here we are. If you take a look, let me scroll down and show you that this is the returns, the compound annual growth rate plotted on a chart. I love charts. I say a picture paints 1,000 words. And this wasn't by year down here. Don't think that these represent a year. This actually represents an all stock portfolio at this end, an all bond portfolio at this end, and everything in between. So we've got, like, for example, 90% in stocks here and 10% in bonds. We've got 90% in bonds here and 10% in stocks, and everything in between. So that's what is represented. This is for the returns for the decade as a whole. So let's just take an example of maybe a 70% stock portfolio and 30% bond allocation in that portfolio, I should say. So with that, the return was just over 2%. That's the nominal return. A really good point I want to make here, an important point I should say, is the nominal return. That's the numbers. That's what the numbers tell us. But the real return is what we want to look at, because that's the after inflation return. That's what we get to keep. That's what really the return that we make when we get rid of inflation. So during this time frame, we can see that 2.47% of that increase was due to inflation. So we want to throw that out and we want to look at the real return. So with that stock bond portfolio, 70% stocks and 30% bonds, we see the return was a little over 2% for nominal return, but the real return was slightly negative for that time frame. So that's what I wanted to show you in here on this chart. You can come over, take a look at these again. They're fantastic. But what I want to do is show you why this was such a shocker for us, and I'm going to pull that back to today. And let me show you. That's because here is the 1990s decade. This is what had just happened in the recent past. Here's an all stock portfolio, and again, same thing. Here's the 70-30. One thing to remember, though, that's super important is bonds had much higher interest rates in the 1990s decade. So naturally, bonds had higher returns than they did in that next decade, and certainly the subsequent decade that we've just experienced, where we're headed next. Okay, so the point I want to make is take a look at this and the return here, and let's just, for simplicity, let's just be consistent, and let's throw out bonds and let's just look at all stocks, because of the change in interest rates, bonds have got a different dynamic going. They have for the past decade. Let's take a look at this all stock, and we see that there was almost an 18% return. And if we look at that, sure enough, 18% for the 1990 through 2000 decade. And then let's just take a glance at that chart, and then let's scroll down, and then here was the 2000s decade. And then let's take a look here at the 2010 through 2020 decade, and not quite as high, almost 14% for an all stock portfolio. The reason I'm bringing this up now, this particular 2010 chart through 2020, is it's bringing us back to today. I wanted to circle us back to the 2000s decade, I should say. But what we can learn from the past and how we can apply that to today. And the way we can apply it to today is to say, wow, this was a stellar bull market here that we went through in this decade, which actually began in March 2009. And we did have those two little bleeps that were sort of really short bear markets in this decade here, 2010 through 2020, due to a couple different factors. But having said that, in general, it was an overall extended bull market, and a lot of people disregard those two little short bear markets that we had altogether when referring to this decade and the performance of stocks during this decade. And that leads me to the next shocker for us, was that bear markets, we tend to think they come along maybe once a decade, possibly twice, but usually, at the beginning maybe of a decade, and they're spaced out quite well. Well, there were two nasty bear markets in this first decade of the 2000s. And that was shocking to us. People were just getting back on their feet after that first bear market from the tech bust, and sure enough, then there was the financial crisis, which took down a lot of real estate values as well. And that leads me to the third shocking reality that we got in retirement, and that is that during stock bear markets, net worth takes a double hit. Let me explain that. First of all, it takes a hit because your stock portfolio has fallen significantly during a bear market. And the other thing is that stock investors hold off on buying a new home after a bear market or during a bear market because their net worth it's been hit really hard, and people who have experienced that decide to hold off on buying a new home, and then that hits your net worth in another negative way because the value of your home decreases. So these were three shocking truths that we learned about retirement after we took an early retirement. Remember, above all, retire certain.